Excellent, everybody. Welcome to the Leaders in Housing Counseling call, our summer August edition. And looks like we're going to have a really good turnout today, even though it's August. So thanks everybody for jumping on the call. And what we're going to do is just do a quick promo about next week's call, and then a little review of the agenda, and we will then really spend most of the call on the FHA and various other waterfalls. And so I'm just going to dive in because we're going to have a lot to go through, and I think you'll have a great time. So please use the usual box to put in your questions and thoughts as we go along, and there'll be time for our questions and answers. All right, so next week we're going to have David Berenbaum and Jerry Mayer from HUD to talk especially on certification, though we appreciate David and Jerry have always been pretty flexible, and so if there are other HUD things you'd like to raise, this could be a forum for that as well. But that's the link if you haven't signed up already. As you know, we've had David and Jerry on before, and this will be very useful for all of us, and we've been hearing a lot of questions about certification, so this is meant to be a deeper dive to help address those and help people understand and how to maximize the opportunities here. But we'll also be open to other issues if you want to raise them. And then, but really the call today will be focused on the servicing updates, and we're really pleased to have Julian Josephs here, who is somewhat new to HUD, but has had a good working history with many of us over time, and brings deep experience in the industry, has experience with housing counseling, and we're thrilled that she's at HUD. And then Steve Sharp, who you all are getting to know as your new best friend, because Steve's been on several times to really help unravel lots of the details here and make them accessible to counselors. So that's what the bulk of this call will be about. We've got a whole bunch of NHRC updates to bring you up to speed on, and which Ellie will do, and then I'll do a quick set of legislative updates, and we'll close out the call after that. So I'm going to really hand the call over to Ellie to get us started on the servicing updates so that we can get down to work. Thanks, everybody. Ellie?
Great, thanks so much, Bruce. We are really excited to have Julian Joseph, the Deputy Assistant Secretary for Single Family Housing at FHA, on with us today. Julian comes with quite the pedigree. She actually was a home ownership advisor for a time in the beginning of her career at NHS Baltimore. So in her most recent place, she was with the Mortgage Bankers Association. And Julian has always been really supportive of housing counseling and understands what we do. So we're really happy to see her at FHA and really excited that she's joining us here today. So Julian, go ahead, take it away.
Wonderful. Thank you so much, Bruce, and thank you so much, Ellie, and thank you so much to NHRC for allowing us to just have a conversation today and to answer some of the questions that you may have. I'm also accompanied today by two of my colleagues, Lisa Saunders and Matt Martin, who also work in our asset management. So in the question and answer period, if I needed to phone a friend, that they're here with me as well. So thank you to both of them for joining us today. So what we basically wanted to do is just walk you all through some of the changes that we rolled out at the end of July from our existing COVID waterfall to the revised COVID recovery waterfall. And this is the slide that we basically provided on July 30th in the conversation that we had with Bruce and the MMCC working group, where we were basically revealing our new recovery waterfall there as well. So just to go through the COVID waterfall as it was rolled out in June, Mortgagee Letter 2105. The original waterfall began with the COVID-19 standalone partial claim, and that was for borrowers that were able to resume their current payments and didn't need to, include, well, it could include the arrearages, but they were able to resume the payments without needing any payment reduction. So then the second step in the waterfall was the COVID-19 owner-occupant standalone modification. And then from there, it went to combo of the partial claim and the loan modification. And then, of course, the fourth step in the waterfall was the HAMP for deeper payment reduction that would use the combo PC loan modification with limited documentation. So that's where we started. And then when we released the new COVID recovery waterfall on July 23rd, we had incorporated the advanced loan modification. Now, that's not actually a part of the waterfall. What that is almost a preliminary step that for those borrowers who are more than 90 days delinquent, but weren't necessarily as responsive as we would have liked in order to offer them an option, the would be a resource to help those borrowers that were not actually communicating with their housing counselors or their servicers. And, that way, when the servicers would review their portfolios, but the borrowers who were actually eligible for that, they would then be presented with that option if they were to meet the criteria. So that would be the preliminary step before entering into the waterfall. Now, just before we actually get into the actual steps of the recovery waterfall, we wanted to share with you the motivation behind the advanced loan modification. Primarily, the data has shown us that 25% payment reduction significantly reduces claims and the opportunity for redefault. And what we also wanted to do was do what we could to preserve the partial claim option for borrowers. Of course, we know that we're entering into hurricane season, natural disasters. So what we didn't want to do is necessarily utilize all of that partial claim eligibility on the COVID response. And then if borrowers did need that claim later on because of natural or imminent natural disaster, that their partial claim eligibility had been used up for COVID. So for those borrowers that we could assist who needed the payment reduction in order to remedy the mortgage, we wanted to look at that before automatically going to the partial claim. So I just wanted to share with you guys what the motivation was in creating that pre-waterfall step. So now, actually entering into the recovery waterfall, the first step would be the standalone partial claim. And of course, that's similarly to the previous waterfall. That's for the borrowers that can resume their actual payments. Now with this, there's a maximum 25% partial claim for arrearages to bring it current. So what we didn't want to do, and I know that a lot of you are aware that 30% is the maximum claim amount that could be utilized. But what we didn't want to do is completely max out the partial claim here to leave a little bit of opportunity, whether it was needed for any other emergency or for deferral. So the maximum partial claim that could be utilized for the arrearages would be 25%, leaving that additional 5% there for another instance of hardship, or if it needed to be used for deferral. So then the second step in the waterfall is the COVID-19 recovery modification. And of course, that's the 30-year rate and term plus the COVID partial claim. And again, the target is 25% P&I without a DTI calculation. It's priced at PMMS flat, and it's rounded to the nearest eighth. And then the third element of the 30-year rate and term plus the COVID partial claim is that it can be used for arrearages. And again, it is maxed out at 25%. Now, something that I really want to underscore, because we've had a lot of people reach out to us about concerns about the HAMP not being in the waterfall. What we want to underscore here is that the target for borrowers is 25% payment reduction. If you have a borrower who reaches out to you and says, okay, well, you know what, 25% just isn't deep enough for us, we need to go beyond that. If there is room within the partial claim up to that 25% and the borrower needs deeper payment reduction assistance, then you can go beyond the 25% payment reduction if the partial claim allocation allows for that. So, which basically kind of alleviates the need for the HAMP. Because you can go beyond 25% as long as the claim, gives the borrower enough claim eligibility in order to go deeper than 25%. And also in that the second step of the second step in the waterfall is the 30-year modification plus the partial claim for deferment. And of course, that targets the 25% P&I as well without DTI calculation. That too is also priced at PMMS flat, and it's rounded to the nearest eighth. And then this partial claim can be used for arrearages and principal deferment, as long as it doesn't exceed the 25% partial claim. And again, just to reiterate what I was stating for how this basically works as not a replacement for the HAMP, but is as effective, is because if the 25% payment, principal and interest payment reduction is not enough and is not achieved, then you can offer the lowest payment. So either it can be, if there's not enough room in the 25% partial claim, then of course you offer the best payment. If there is still room within the partial claim eligibility, then of course the borrower can go deeper than the 25% principal and interest. So these are basically the changes that have taken place from the existing the previous waterfall that we announced a couple of months ago, and these are the new changes that we've provided. With that being said, we did solicit a lot of information and input from the industry in crafting this, to make sure that it was addressing the needs of the borrowers. And of course, there was a little bit of feedback that we received after rolling out the new recovery waterfall that we needed to do to create a little bit of tweaks to help them operationalize the implementation of the waterfall, and we addressed those in 2 waivers that address some timeline issues that have been shared with us. So outside of that, that's our recovery waterfall, and of course we welcome any other feedback from the industry. We value the housing counseling industry so much because we all know that we are not siloed here, that we are all part of this ecosystem, that the housing counselors and the servicers work in tandem. So any information or any concerns that the housing counseling community has for us or any input, we're absolutely open to that, and we'll continue to have this dialogue with you all to ensure that the policy is helping our most vulnerable borrowers and population. So I'll go ahead and turn this back over to Ellie.
Great, thanks so much, Julian. So people should go ahead and put their questions into the question box. We are gonna move right on to Steve Sharp with National Consumer Law Center. And you've all heard from Steve before, as Bruce mentioned. He's really been great about informing us on what's going on with all of the FHA, VA, and USDA changes. And along with FHA, there were some other changes that Steve is going to talk with us about today. So Steve, go ahead.
Thank you. So it has been, thanks everyone. I have until 1:50. So we're going to try to cover as much of this as possible. 2 things I will say is there are 2 links to articles in the slides from National Consumer Law Center. One about the Reg X rule update from the CFPB that you all will probably care about, which is an entire article, and one outlining the truly massive number of changes we had between June 24th and July 23rd. Probably the busiest month of policy that we can have. So there's a lot to cover. Some of it will be in the slides. I will give a broad overview, but as Ellie showed, my contact information is there. So happy to hear from you all if there are questions about any of this. And maybe we can break things down further in future calls, but we'll do our best to provide an overview here. And thanks, of course, to HUD for cutting out several of the slides I have here by covering their waterfall, so appreciate that. I want to say to begin the part that you all know, which is that we are at the hardest part of this crisis, which is the time when we're moving borrowers from forbearance to post-forbearance. So this is, we know this from the previous financial crisis, just how challenging it was operationally to get our clients, and I was a legal services attorney at the time, get our clients the relief they deserve, that they need, that they are eligible for. And so, we're there right now, having people move to the solutions that they need to stay in their homes. So please continue all that you have done, connecting with Ellie, connecting with Bruce, with us at NCLC, to tell us what you're seeing on the ground. There has been so much policy change, like I said, that your role in this is extremely crucial. So just want to keep lifting up the work you do, how important it is, and as much as you can do to share what you're seeing on the ground with others, please continue to do that because it's been really critical. So next slide, Ellie. We're going to do this in 3 buckets, the 3 buckets that we are used to, except we're going to put a little asterisk on it because we have something from the CFPB. But right from the beginning of COVID, we've sort of had 3 basic categories of relief. Moratorias, those pauses, wholesale pauses on foreclosure activity done at the investor level and initially with the CARES Act. So pauses on the initiation of foreclosure. So we have some changes there. Forbearance, the individual pauses, that breath of fresh air, that little space for recovery, forbearance plans, the pauses on payments that of course do not eliminate the need to make payments, but that give the borrower space to recover. And then the final category, so they can move into loss mitigation options, modifications, those tools that bring the borrower current. So we have broad updates on all 3 of those categories. So in addition, and as we know, just to say, like, those 3 categories have really been focused on federally backed loans. So loans, FHA, VA, USDA, Fannie Mae, Freddie Mac, those are where we've had rules and protections in place and things you can point to. So unless you're in states that have done some things on their own, there have not been as many protections for federally for non-federally backed loans, for loans that are not FHA, VA, USDA, Fannie Mae, Freddie Mac. However, we do now, released in the end of June, have a regulation from the Consumer Financial Protection Bureau that provides some procedural protections for borrowers. Next slide, Ellie. The slide before that she's on right now, before she changes, has our article, which I really encourage you to read because that kind of spells it out. But I'll give you some really broad strokes. So go ahead now, Ellie, and switch to the next slide. The most important thing, I think, to recognize about the regulation is that which comes into effect August 31st, is that it applies to federally related loans. And you might think, so there's a difference between federally backed and federally related, and I am here to tell you, yes, there is. Sorry for the lack of spice in the language we have around loans, but there is. Federally related loans cover a much broader definition of loans than federally backed loans. Federally related is the vast majority of the market. Those are the ones where the RESPA, the Real Estate Settlement Procedure Act, applies. And so that will get into a lot of the private label securities and portfolio loans. So the Regulation X protections cover a broader scope than the federally backed, but they don't, next slide, Ellie. What's important is, though, that they don't provide specific options for relief. So for actually helping a borrower resolve their issue, you still have to look at those investor guidelines. There's nothing, what HUD just ran through, for instance, for FHA insured loans, what VA has, what Fannie Mae has, what Freddie Mac has. Those are still what you use to determine the relief that's available and the rules for forbearance. What the reg does, the new rule does, is provide some procedural safeguards before the lender or the servicer can initiate foreclosure. So this applies to the initiation of foreclosure. And there are some, and the article goes through what the exceptions to those are and what the procedural safeguards are, but there are things like making sure if the borrower has been evaluated on a complete application, that gives the servicer an off-ramp to proceed foreclosure. If the borrower's been unresponsive, as defined by the regulation, that gives that off-ramp to foreclosure. So they also, the CFPB also allows for streamlined modification. So along the lines of what we just heard from HUD, the regulation just allows for those streamlined full complete documentation applications, and also put some early intervention requirements, some outreach and requirements that servicers have to do in order to try to engage borrowers as early in the process as possible. So, you know, these are not there for, again, just repeat because it's worth understanding, these do not provide the modification rules, but the regulation does provide some interesting and important procedural protections for folks who are in with COVID hardship. So Ellie, why don't we go to the next slide? And let's get into what the changes have been, because there are a lot. I counted 14 between June 24th and July 23rd, and our article here goes through what those changes are. We got updates from every single agency and the GSEs in the last month, so it is going to be up to all of us to sort of be able to process that. But let me give it to you in some broad strokes. So next slide, Ellie. Probably most importantly is the foreclosure moratorium are now over, except unless you're in a state, and I think Oregon, for instance, just extended their state-based foreclosure moratoria. The federal agencies have ceased their foreclosure moratoria through July 31st, 2021. Now, this is different than, and I think some of you have probably seen that there are still some eviction moratoria in place. And so, of course, there's the, I'm not here to talk about like rental eviction, the CDC moratorium. That is all for people with a lot more expertise in that than me. But there are some there's still eviction, like for instance, HUD through a mortgagee letter has an eviction moratorium still in place, meaning the mortgagee on a single family insured loan can't initiate or continue with an action eviction to regain possession of the foreclosed property. So that difference between the eviction part of it and the foreclosure. But moving toward foreclosure, getting to that foreclosure sale, that is all has been canceled effective ended, I should say, July 31st, 2021. Next slide, Ellie. I should note though, and so let's remember where we are then. We are in sort of a period of unclear protection for the most part. So we are at the end of the foreclosure moratoria, and we are before the effective date of the CFPB rule that puts procedural safeguards in place before initiating foreclosure. So the CFPB rule will provide some protection when it comes into effect, but it's not in effect yet. And so at least for Fannie Mae, so we're in sort of a limbo space right now for the next 12 days. Fannie Mae and Freddie Mac, however, have implemented a bridge between the end of their moratorium and the effective date of the regulation. And you can see in the press release what Fannie and Freddie are saying about that. That servicers won't, basically that servicers have to start following the CFPB's procedural protection this month, even before the CFPB rule comes into effect. So at least for Fannie Mae and Freddie Mac borrowers, there is that extra level of bridge protection. The federal agencies have not done that. So we're hopeful that there's not a lot of foreclosure activity right now, be useful if you see it. Please, let everyone know. But we should hopefully start having the protections of the CFPB rule. The protections of the CFPB rule will be in place in 12 days, and hopefully there's not a lot of foreclosure activity on the ground. But at least for Fannie Mae and Freddie Mac, those servicers should already be following the obligations of the CFPB rule. Let's go next slide, Ellie. I'm sure there are a lot of questions, and I know some of these you may just have to ask me directly by phone or by email, which you can do, or reach out to Ellie. So I'm gonna keep moving on this. Unless,
Okay,
Ellie, is there anything in there that's really, if there's anything in there that's really pressing, let me know.
Yeah, I'll just throw in a couple of people have pointed out that in their state there's been an extension beyond the federal level.
That's great.
Moratorium.
And it's good, and that's a good plug to. You should always check out what's going on in your own states to see if there's anything going on there. So there can be that at the state or even like probably county level. Now, so that's the moratorium. Forbearance, we still have the ability to start forbearance plans, and boy, do we need it, obviously, right now with cases increasing tenfold. We are still in the throes of this pandemic, and I'm continue to be concerned about this. Obviously, me and everyone concerned about the effect of the current wave of the pandemic on borrowers, and so as I'm sure you all are too. So on the forbearance side of it, there is still the ability to access forbearance. So Fannie Mae and Freddie Mac do not have deadlines for when you can start initial forbearance plans. They have, my sense is still you're going to be capped at 12-month forbearance periods in those increments, but you should still be able to, if you have a COVID hardship, reach out to your Fannie Mae or Freddie Mac servicer and access forbearance relief that you need. And believe me, if you're seeing clients who are not able to do that, please let Ellie know, let folks know, because it's important. So that Fannie Mae and Freddie Mac, no deadline in their guide to start initial forbearance plans. The federal agencies, the FHA, VA, USDA, have given borrowers until there was a previous deadline for starting forbearance plans of June 30th, 2021. That was extended to allow borrowers until September 30th, 2021 to start initial forbearance plans. With the state of the pandemic as we are, I think there's going to need to be some continued work just to see about where, if that deadline is adequate. But as of right now, borrowers are still able to access their initial forbearance plans. Next slide, Ellie. It is important to note, and they do have a chart, HUD has a chart in Mortgagee Letter 2021-18 that you can look at to see how much forbearance a borrower can access based on their start time. But it's important to know that FHA has limited the maximum length of forbearance plans to 6 months for borrowers starting forbearance after June 30th, 2021. So again, that June 30th date, which is where the previous deadline is no longer a deadline for accessing, but it does, if you have a client access after June 30th, 2021, they are limited to 6 months of forbearance under HUD's rule that was started in the previous mortgagee letter and then continued in the most recent mortgagee letter that was referenced earlier, 2021-18. Next slide. I will note that USDA, VA, Fannie, and Freddie do not have such limits. Fannie and Freddie just say 12. Their forbearance rules are baked into their servicing guide, and so it's 12 months just as a matter of course. is what the max length is, unless you're in one of those extended forbearance periods, which are now gone. So they're, you know, taking the Wayback Machine to when I was talking a couple months ago, and there were periods where you could get up to 15 or 18 months of forbearance. I believe, well, you may be within one of those, but not for loans of that. Sorry, not to start. You can't get 18 months under any program if you've just started the forbearance after June 30th, 2021. But you can at least get 12 according to Fannie Mae, Freddie Mac. USDA has stated the maximum term is 12 and not 6. VA's guidance doesn't directly state it, but also does not. It just extended the previously issued forbearance rights. So presumably VA is still at 12. So we're left with HUD, and we, and I know a lot of you all working on this, we have issued comments and sent out comments, a sign-on letter saying we think that should be out to 12 months. And I think we're going to send another one soon in response to the mortgagee letter saying, you know, to get in line with the rest, and especially with where we are in the pandemic, that 6 months may not be enough for folks, especially if they're starting in this new wave of cases. So, but putting that aside, the rule is pretty clear now that most of them are 12 except HUD, which is 6. Next slide, Ellie. Okay, so moratorium, forbearance. We have the updates there. Now the post-forbearance concepts. I think this is probably not a slide for you all. I think you all working on these on a daily basis have a very good sense of what types of options are generally available. But just to remind you, we kind of have like different types of options. We have the partial claim deferral types, which will restore, for the most part, borrowers back to their pre-hardship payment using some tool, partial claim if you're HUD, deferral if you're Fannie Mae, Freddie Mac, mortgage recovery advance if you're USDA. But all of those tools restore the pre-hardship payment by putting some amount of money at the back of the loan. Then you can have these combining partial claims of using a non-interest bearing second lien or second position or deferred amount in combination with a modification that changes the terms of the loan. This is what HUD went really well earlier, kind of the combination of modification and partial claim. And now we have, I think, a concept that has become really standard across all of the federally backed loans, which is targeting payment reduction. Heard from HUD, targeting a 25% reduction in the principal and interest. We now have that in all of in Fannie Mae, and then we'll go over Fannie Mae, Freddie Mac, and then we'll go over how it works in USDA and VA. But these are sort of the building blocks now of the types of ways we're trying to help folks with COVID hardships. So next slide, Ellie. So no changes in the options for Fannie Mae and Freddie Mac recently. So we still have deferral and flex mod, but there was a very big change to how the flex mod is calculated, which thanks to folks who worked with us to advocate with Fannie Mae and Freddie Mac on this. The big change is borrowers with equity, a significant equity stake in the property, generally defined as 80% loan to value or lower. So they have their loan is much less than the value of their house. Those borrowers with that equity can now obtain interest rate reductions in their flex mod requests where they could not before the change that was made at the end of June. So now there is the opening up of interest rate reductions for borrowers with equity with Fannie Mae and Freddie Mac loans, at least to help address a COVID hardship. This is not, my understanding, a change yet in the non-COVID flex mod rules. So this is a big deal. Before, borrowers with equity couldn't get interest rate reductions, and that greatly limited the number of the amount of relief that borrowers could get, especially in a subsequent flex mod. Next slide, Ellie. So what's important for counselors is that you may now have borrowers who were denied flex mods, and they would be denied that primarily because a flex mod could not provide the payment reduction that it's supposed to provide. But now, if there is, so if you have a borrower who before the change was denied because it didn't get a payment reduction, with the change in the interest rate policy, that borrower may now be able to access a flex mod. So that's kind of a one big change, or one big effect of the change in policy. The other big change in policy is that some borrowers may now get deeper relief, even those that would have been eligible for flex mod. Of course, if you can get a lower interest rate, you can get deeper payment relief. So it was sort of a little under the radar change from Fannie Mae and Freddie Mac, but it could have pretty decent impacts on what borrowers are offered. So again, last reminder, now interest rate reductions allowed for Fannie Mae, Freddie Mac flex mod for COVID hardships when those borrowers, even if those borrowers have equity in their property, a substantial amount. Let's keep going, Ellie. We're going to skip over all of the FHA stuff because you have heard that, and we're going to go to, it looks like slide 23 or 24, Ellie, on VA. Sorry, there we go. Perfect. So VA, a guaranteed loan program, made a total update on their options available for borrowers facing COVID hardships. Before, and they still sort of suggest they do, they had a suggested order of relief available for borrowers who were facing hardship. But it wasn't, I would say it wasn't as formalized and detailed as what there is now. So before, basically, it was kind of work with the servicer, with the borrower to get one of the options that would be most appropriate. Now, VA has done two things through the circular 262113. They have created I think a really helpful flow chart, some structure as to categories of borrowers, and then added a new loan modification option for borrowers who need a modification. So let's go to the next slide, Ellie. We'll go through that. So we have three buckets. So first bucket is the obvious kind of one, which is if borrower, probably the person that we are not seeing. I mean, I'm not saying they're not out there, but never in a legal aid office did I have this borrower. Probably not at a housing counseling office do you have this borrower. But presumably there are borrowers who can not only afford their pre-hardship payment, but they also can afford to repay the arrears. And so those borrowers who are in that kind of a lucky spot are offered a repayment plan. I don't know if I don't know that those folks are ever going to make it through your door, but there is that category there. A common one is the borrower who can afford their pre-hardship payment but can't afford the arrears. This is pretty standard. The person who just needs, who maybe got a new job, was able to get back on their feet, but just can't afford whatever that they missed the previous months. VA now has, VA sees three options, but I think most importantly, they have a newly released partial claim program that is modeled on HUD's partial claim program. It functions very similar. You know, is a interest-free, or sorry, it doesn't bear interest due about the end of the loan. there to cover the amounts past due. But that is new. It was effective, I believe, July 27th. And so for those of you who have done VA cases before and didn't think there was a partial claim available, that has changed in the very recent past, and so now is available. Additionally, so then if you're in category 3, also a category that we see a lot is borrowers who need payment relief. This is the person who has recovered enough to start making payments, but simply cannot pay the mortgage payment that they had before. And so VA now has a targeted loan modification system, which is new, which can, like with what HUD described, combine a modification with a partial claim type program. They call it a refund. I don't think the nomenclature matters as much as you now have a program at VA to address if people need a modification. And they again now are targeting between a 20 and 25% reduction in principal and interest through their program, which can be a modification and partial claim combined. What's important from a counseling perspective to understand, I always, in these cases where it may be a combination partial claim and modification, it's always good to talk to your clients about that, because it can be weird to get a big pile of documents that has a note to like VA and a note to the servicer. So just keep in mind that this can be one of those situations where if client is eligible for it, they might get a big pile of documents for execution. If under VA system, the borrower needs more than a 25% reduction, there is an avenue for that, but kind of as you would expect, or is not so surprising, the avenue to get more than a 25% reduction in payment for those who need it will probably involve submitting some financial information to the servicer. Again, and I skipped over this a little bit because we missed because I skipped by HUD's portion of it because they covered it so well. But again, a lot of these options, these VA options, what's talking about with HUD, do not require that full financial information that we got so used to providing in the past. For the VA system, this can happen. It's very streamlined, but if you need more than a 25% reduction, you're going to need to apply with some sort of financial information that the servicer needs to review you for more than that. And then let's do the last slide, which is VA or USDA guaranteed loan program. Again, always challenging to note, what is the USDA guaranteed loan program loans? It is not very easy to determine from the documents. It's not, borrowers are a little bit less clear generally about whether they have a USDA guaranteed loan, as if you do an FHA or a VA loan, where it says it all over the documents, or you pay the MIP under FHA. But you can look at the closing documents if you feel like it might be, you hear that it is, that isn't a mistake. There is a USDA guaranteed loan program, but it is smaller. It's significantly smaller than the FHA insured program. So for those borrowers, what you do here is start out with the handbook says start out with the options that are generally available, and then if you need more, they also have a targeted payment reduction in principal and interest payment, like USDA or like VA and like FHA. They target 25% reduction in principal and interest payment, and they can, like the others, achieve it through a combination of a rate reduction, term extension, or their version of a partial claim. So there's some pretty broad ideas. Moratorium are over. The CFPB rule is coming online soon. We have forbearance available for everyone now, with some of the limitations that I had mentioned in those slides. So forbearance. So we have good news is expanded forbearance option, but that is coming up still. September 30th will be here before we know it. So there's still some things to pay attention to there. And then we have all of these new modification programs online. And I will just say again, you all are there and on the front lines of letting us know and letting Ellie know and HUD and everyone what people are seeing on the ground. So I just continue to, thank you for all the hard work you do on behalf of borrowers, and just please keep letting us know if things aren't working as they're supposed to work. So Ellie, I got 5 minutes before I have to bail. If you want to see if there's questions for me, I'm happy to take them.
Sure. Thanks so much, Steve. We are going to have Ebony Cartwright, our program associate, go through the questions, and we're going to do our best to Steve to ask first the questions that aren't necessarily specific to HUD FHA. So some of them,
Sure.
that we asked maybe FHA, but we're going to do our best to get to the other ones first. So Ebony, what questions do we have?
Okay, can you hear me okay?
I
Sure
can.
can.
All right, so the first question is, I have a client that was denied an FHA deferment because he added his wife to the title after he bought his home. That would not affect his mortgage or note. What law or clause is he violating? Who can he talk to about the situation? And they're also saying that the lenders are not willing to provide explanations.
Well, I don't think that violates any. I mean, to add someone to title, a spouse to the title, this is a whole separate topic, but I don't see why that would have prevented him from getting a deferment. But I will let my colleagues at HUD answer that one.
Okay.
Hi, Ebony, did you
Go
want me
ahead,
to go
Julian.
ahead
Sure,
and
go
answer?
ahead.
Okay, and the one thing that we want to be very careful about loan level actual issues here is because we don't necessarily have all of the information in order to, make a determination about any issues. But anything that you're experiencing, and this is for the counselors, that you are having a specific issue with a particular borrower or lender, our resource center is specifically in place for that to evaluate those case by cases where you're not getting the assistance that you need, that they can look at the full situation and ensure that you get the attention that you need. So, being that I don't have all the specifics for that particular case, but I do want to let you guys know that our resource center is very, very capable to handle that and to help you get to the resolution that you need.
Okay, thank you so much. Another question is, what type of protections are available for persons that have a loan for mobile homes?
Yeah, we didn't cover mobile homes. That's a tricky one, and Ellie, that might be something to talk about in the future to cover mobile homes.
A future topic, yeah.
Yeah, I think that might be good for a future topic because I suspect folks are seeing that. We have some information in our NCLC material, but I think that's probably a little too broad for me to handle now. If they're HUD insured, of course, loans, they're going to be in a different boat. But a lot of them aren't. It's a real. It is not unless they're covered specifically by any of the investors that I just mentioned. They're not going to be. You'd have to look to see if they're covered by anything that I mentioned, but that's a different type, and it might be good for a future conference.
Thank you for that. One last question. What if your lender does not honor your the forbearance?
Well, I mean, I think, what should you do if they're not following the rule? I think complain to whatever investor has the loan. Maybe reach out to, this is where it can be good to make friends with folks in legal services community to see if it's the type of thing that a legal services lawyer should look into. Ellie, do you have any? I'm curious what you would say to that, Ellie, in terms of what a counselor should do.
Well, I mean, it depends on who the investor is, right? If it's FHA, of course, you would want to reach out to FHA in the way that Julian just described. If it's Fannie or Freddie or USDA or VA, again, you'd want to reach out to those entities. And as always, I encourage people to file a complaint with the Consumer Financial Protection Bureau. And if you are a HUD-approved housing counseling agency, you can access our escalations contacts, and you can email me directly to get the password, the link for that, and the password. Again, you have to be a HUD-approved housing counselor in order to access it. But you can email me at epepper@hsgcenter.org, and I'll get you that list. And then if your servicer isn't on that list, we can talk further about what your next steps should be. And I bet Steve and other folks at NCLC would love to hear those kinds of stories.
Yes, yes, we would. So I have to leave now. It's always a pleasure to talk to you all. Again, you have my contacts in the PowerPoint, and look forward to the next time I can join you all. Thanks everyone.
Well, thanks, Steve. And what we'll do is we will send you questions that our FHA folks haven't been able to answer that are about other topics. We'll send them to you, and we'll get the answers out to everybody who attended.
All right, thanks everyone. Bye.
Okay, so Ebony, continue on with questions that hopefully the FHA folks can answer.
Okay. So the next question is, do servicers have to review all clients who are 90 days delinquent or more for the ALM, even clients who were never on a forbearance?
Okay, can you guys see me? Are you able to see me?
Not yet.
Okay, there we go.
go.
All right. So with the ALM, and I think that this is a question for the advanced loan modification. I believe that that's what this question is targeting. So what we would basically, what we're asking for servicers to do is to do a quick analysis. And the good thing about this is it doesn't require any effort on behalf of the borrower, because we're not looking at anything for debt to income. We're strictly looking at reducing the actual mortgage payment. So this doesn't require a heavy lift, because literally for the borrowers who are 90 days delinquent, literally if a 25% payment reduction would help them in the system, then that's a quick analysis that can be done. So instead of having to actually contact the borrower in order to make that determination or to collect any type of income documentation, literally the servicer can do that only for that niche group of borrowers who would be eligible for it. And I believe that we calculated it would be under 200,000. So it's not the entire portfolio, but only for those borrowers who would fall into that box.
Okay, thank you for that. Next question is, what options can a client get if they have a $203,000 loan? They ran out of funds and is not.
I'm sorry. Just to say, it's a 203K loan.
203K. Thank you so much.
Yeah.
They ran out of funds and they're not able to complete the renovations.
Okay, and I might have to tag in a friend for this. I might have to tag in Lisa for this. But my understanding is that we issued an ML that will allow the construction to continue on 203K loans. But I'm gonna tag in Lisa Saunders for that one. Lisa, are you there?
Yeah, I'm here. I guess I'm just, can you repeat the question or give us a little bit more information? You're just saying on a 203K, you've run out of money?
Yes, and they're not able to complete renovations.
Is this due to COVID? Is this due to a COVID related issue?
Yes.
Okay, so this one, and I think that we might need to get a little more specific if it's because of hardship that they're not able to complete it, or we would probably need some more information on that situation, because if it's not enough funding because of the loan amount, or if it's due to COVID that they don't have the ability to pay, there could be different interpretations for that. So we would probably need some more information before we could answer that question fully.
But
It looks like the person who asked this question doesn't have enough funding. It was not due to COVID.
Okay, so this is just a separate 203K issue that it has just run out of funding for that. So again, that's another question that would be directed to the National Resource Center. They would be able to assist with that with that question.
Okay, thank you so much. So the next question. So processing foreclosure files is delayed for 202. When should a client who is under forbearance now begin applying for the FHA programs to help with their current mortgage?
Okay, so not quite sure what the 202 means, but if there's a borrower who is currently in understanding that they are being impacted by a COVID hardship, absolutely, we recommend that they go into a loss mitigation option now instead of necessarily waiting until their forbearance ends. If they are already in forbearance and they know that their situation isn't going to get any better, of course, what we would recommend is for them to start working on a loss mitigation option now. One, because that will assist with the arrearages. So of course, with forbearance, we understand that payments are not being made. So therefore, the payments that aren't being applied are just continuing to accumulate. So if there's an opportunity for a borrower to reach out to their servicer now in order to create a permanent loss mitigation option, we absolutely encourage them to do that now. And of course, the waterfall was effective July 23rd. So, I hope that answers the question. But yes, the recommendation is to seek loss mitigation help now and not wait until the forbearance period is over if they know that the hardship is imminent and will continue.
Okay, thank you so much. Next question. I have a client that has a Fannie Mae loan. She was offered a Fannie Mae Flex modification with no interest rate reduction, only extending the term to 40 years. The modification is a couple of more dollars than her current mortgage payment. Are there any other options for her?
Well, given that that is an FHFA product, then they would have to work with within the constraints of the FHFA waterfall. So we can't speak on that because that's a different program.
Okay.
We'll get that one over to. That's one of the questions we'll get to Steve.
Yes. Mm-hmm.
Post webinar.
Okay. Let's see. Can a borrower in forbearance still apply for a modification prior to the end of the forbearance? Can a servicer refuse to review a borrower for a modification until after they have exited forbearance?
So again, if they are currently in forbearance, they can begin exploring loss mitigation options. Yes, they can.
Okay. Is the 25% calculation based on the original mortgage payment?
It's based on the existing. So whatever their existing mortgage payment is, it would be a 25% payment reduction of the current payment.
Okay, thank you. As a counselor, would we just submit a financial packet to the servicer and the borrower would review for whatever is available or whatever they are eligible for? Or would we need to ask for a particular program on behalf of the borrower?
So there's no financial package for FHA. So what we would recommend, of course, is to involve the borrower as much as possible in that conversation. With that being said, that's why the waterfall is basically there, that instead of going straight to an option somewhere in the waterfall, it's graduated. So you start with options, and as the borrower needs deeper assistance, you go deeper and deeper into those options instead of just going straight to the waterfall and picking an option out of the actual natural progression of those options. So instead of saying, okay, you know what, I just want to skip, the first step of the waterfall, I want to go to 2B. The recommendation is for the borrower to start at the top and to see if there are other, that as they go through the waterfall to find out what the best option is. But just keeping in mind that, ultimately it is the borrower's decision which option they go with. But to ensure that there's not an option that would be better for them, we recommend that you start from the top of the waterfall and work your way through instead of skipping a step that could be more beneficial or advantageous to them, and utilize less claim option for them if that's possible.
Okay, thank you.
Mhm.
Next question. What if a borrower's loan came to maturity during a COVID forbearance? The servicer will not extend the forbearance and is demanding payment in full for arrears because the loan has matured. No post-forbearance remedy is being offered. Is this correct? This involves a Fannie Mae backed loan.
So this is one that we'll send to Steve as well.
Yeah, that's
Okay.
Yeah.
Thank you. So are all of these options available only to people affected by COVID? What if someone falls behind for non-pandemic associated costs?
So yes, so this is the COVID waterfall, but we do have our existing loss mitigation options that are available. But these are the options that were specifically presented are for, for COVID related hardships. But we do have our existing modification and recovery options for borrowers who are outside of COVID.
Thank you.
That's part of the permanent waterfall that exists. Yes.
Okay. Thank you so much. One last question. In order to get the ALM, do clients have to attest to having a COVID hardship if they were never in a forbearance?
Okay, so do they have to attest? Lisa, I'm gonna ask you about that one. I know that I'll ask Lisa about that. They have to actually attest. No, I don't. No, they don't have to attest.
Oh.
So basically, and we tried to make this not onerous for borrowers, but if they're innocent, and again, the ALM is typically for people that are not being responsive and are already delinquent. So if they are delinquent, they are automatically eligible for the ALM.
Okay, thank you. I had a couple more questions pop in if you have time.
Okay, yes.
So the next one is, I was under the impression that the servicer was not allowed to report the loan as delinquent if they are in a forbearance plan that is now being reviewed for a modification. I'm assuming that is. Did something change since they are reporting negativity on the reports?
And this might be a question that you guys might want to direct towards Steve, but no, it has not changed. Again, if it is a COVID-related forbearance, then and under the CARES Act, it should not be reported as a delinquency. No.
Okay.
And it definitely does not change for FHA.
And we will submit that to Steve, but I will say, just so people know, they are, some of the servicers are, we had a session on this actually back earlier in the year, and they are actually reporting kind of disaster related codes, which may be what is impacting the credit of your client. But we'll submit the question to Steve for more detail.
Thanks, Ellie. Okay, next question. If BWR has submitted mortgage assistance package for FHA loans and it is in process or review, and a new waterfall option now exists, will servicers review for the most recent without BWR or a counselor requesting it?
I think BWR means borrower. That's what I'm assuming.
Okay.
Thank you.
Okay, so again, and Lisa can correct me if I'm wrong, if they are already in or they're currently in an executed loss mitigation remedy, Lisa, are they eligible to take advantage of the new recovery waterfall options, or are they committed to the existing executed agreement that they're in?
So is the question that they've completed it or they're in process? Because if they're in process, the servicers don't have to cut over to the new recovery waterfall because we issued a waiver. So the waiver means that they don't have to do it. They could do it, but they don't have to do it until the effective
Not required. Okay, thank you, Lisa.
Sure.
All right. Thank you so much. That's the end of our questions.
Great, thank you.
Well, yeah, thank you so much, Julian. We really appreciate your time today. We know that you're really busy, and I can't tell you how much we appreciate you taking all this time today to do a presentation and answer all these questions.
Absolutely, and again, as I mentioned before, we truly value the relationship with NHRC and with the housing counseling community. Of course, I'm an alum as well, so thank you so much for all of the work that you all do. It is truly mission-driven work, and the impact that you're having in not only helping FHA borrowers, but all borrowers is invaluable, and just keep fighting the good fight. So thank you all so much for the work that you do. And we look forward to keeping in touch with you.
Thanks, Julian.
Okay, take care, everyone. Bye-bye.
Bye-bye. Okay, so we will move on and quickly do some updates. So some updates from us. Next week, as Bruce mentioned earlier, we are going to have David Berenbaum from the Office of Housing Counseling and Gerald Mayer talking about some updates on certification and answering your questions. Ebony did put the link to register in the chat box so that you can copy that and go ahead and register now. We'll be sending out an email with this information, with the registration. We wanted to do this because we have heard a lot of questions on a few different sessions that we've been on recently, and kind of repeating similar questions. So we wanted to have another opportunity for folks to get clarification on certification related items. The Housing Assistance Fund through the Treasury has now said that state program administrators need to submit their plans or submit the date by which they will have their plan ready by August 20th, which is tomorrow. So we anticipate that many of the states are going to have their plans submitted. You can go to the NCSHA, National Council of State Housing Agencies. Their website has a listing of all of the states that have some initial plans going, some kind of pilot projects that are running. We'll provide that link to you when we send out the recording of this session. So be on the lookout for that. I know that there has been a lot of conversation with the state program administrators about ensuring that they work closely with housing counseling agencies, with legal services providers, and with other community-based organizations. So hopefully you have heard from somebody at your state program, from your state program administrator. We're looking at whether or not you've had any experience with filing a complaint with the Consumer Financial Protection Bureau. We really want to hear about it. We want to hear if you did it, and if you did, how did it go? Did you get any kind of response? Did the servicer act in response to your complaint? Whatever the situation was, we want to hear about it. So please email me directly. My email is here on the screen, and also Ebony put it into the chat box so that you can email me there. And those are my updates for today, and I'm going to move on to let Bruce do his updates.
Excellent. So just a quick things on our legislative world. So I'm sure you've all been following up about the infrastructure bill. That's two bills that have been working their way through Congress. The first one is bipartisan. It's got enough votes to get more than 60 votes in the Senate, it looks like. And in the procedural votes, it already got I think 67, 68 votes. So that's, and that's really doesn't include very much at all that is related to housing or some of the softer things like childcare. But that one continues to move forward. The second one is the bill that has to do with housing and other things, and it's just the Democrats. They need 50 votes. It's a budget reconciliation bill, so you can't plow the ground on lots of program details. It really has to be all things that improve the budget. But the good news is there's like $339 billion in housing, and so there, one of the things is a major expansion on Section 8 vouchers, rental vouchers. There is especially what they're talking about, though we're doing a little bit on the Section 8 home ownership. I'll talk about it in a minute. So that's very important, and it will impact clients and the availability of people to have affordable housing, affordable rental housing, especially. That's very exciting. And the one that we've worked on and talked a lot about is the down payment assistance program, the first generation down payment assistance program, which we think can particularly be helpful in impacting Black and brown home ownership. And you know, we're sort of reading the tea leaves here. We think that $10 billion has been included. There were calls for as much as $100 billion from the National Fair Housing Alliance, $50 billion from the National Housing Conference. You know, there's some pressure to push that number up a little bit, so maybe a couple billions extra show up into that number, but it's still, I think the important thing for us is that it's in the bill. It has a housing counseling requirement. Whenever it passes, we'll do a much deeper dive into what it is and how it might get implemented and how it'll affect your work. But we think that it's a really big opportunity to impact really underserved communities, especially Black and brown families. The one complication is because it's going through the budget reconciliation, a lot of the very thoughtful, very well detailed elements in the bill are likely to get stripped out because they're not considered by the Senate parliamentarian to be budget related enough. So, you know, we're kind of holding our breath on what that might look like. But so far, it does look like down payment assistance is in the bill. It doesn't hurt at all to talk to your House and Senate people to say that you're particularly interested in this provision. But, you know, it's all pretty high level negotiations that are going on now. And we're hoping that, and it's likely that there'll be votes in September where there's a good chance of passage of both these bills, both of which are badly needed. I'll also just say on an area dear to you all, the housing counseling funding. We have for FY 2022, that budget is in the works, as you should know already. In the House, the THAD subcommittee voted out $100 million, so that's what we've been campaigning for, and they've really stepped up. Particular kudos to chairperson of the THAD subcommittee, Representative Price from North Carolina, and Diaz-Ballard from Florida, who've been tremendously supportive. It's just great to see. But the big issue is what happens in the Senate. We have given a pretty good justification for the $100 million figure, and it reflects the kind of volumes and work that you're already doing. But we don't know when we don't know what the Senate will do, and we're not likely to see what's being done in committee until September and the Senate reconvenes. So probably mid to late September, we may get a picture of what the Senate did. There's still a strong feeling that that we won't get the budget passed, the final budget passed in by October 1, which of course is the start of the FY 22 fiscal year. But they will have a continuing resolution, but it's likely to all be sorted out between Thanksgiving and New Year's, and we'll know what the final numbers are there. But kind of moving forward on this. One other piece that we're doing a lot of work on, and we mentioned on the calls, is the Section 8 home ownership voucher program. This subsidizes for very low income people mortgage payments when people are buying a house through the programs. It's actually got lots of value and is widely underused. And so we're doing a deep dive with a broad range of people involved in this area, including people who run these programs at the housing authorities, housing authority trade groups, NARO, which is the trade group for government programs like this. We'll have MBA, we'll have a variety of public policy people, including the Chicago area Fair Housing Alliance. They have all been who've been doing a deep dive into how to make these programs work better. And a few of you, I think, are already on the list here. The meeting's on Monday, but if you are a specialist in this area and you think you have things to contribute about how to improve this program, we would love to include you in on it. We're going to try to put something together. It might be late for this legislative season, and the infrastructure bill is probably too late for that. But we think that with the new administration at HUD, there is tremendous opportunity to revamp this program and a willingness to do it, especially with their commitment to racial equity in the programs that they do. So really big opportunity if this is something that you're deeply knowledgeable about. And for those that aren't, we'll do once we have a program, we'll do a session that's really aimed at how this might work and what are the tools that we're learning. So with that quick note, let me just move on, and reminder that you can still join NHRC. It supports these kind of webinars, but also our advocacy, our lobbying work, really gives us the financial independence that we do what we do. There's still a credit reporting discount available, and Savvy Loan online student loan program, which is helpful for a lot of people. So please feel free to use those if you're members, and please consider joining if you haven't. And we're in the full renewal season for our dues for this year. So please, if you got an email from me or from Ebony about this, or you have questions, ask Ebony about where your membership stands. We really are trying to have a strong year this year, and we're more than halfway there, but still have some ground to cover. So please think about renewing if you haven't already. And then with that quick note, just a reminder that we will be doing our next, and there's Ebony's email address if you have membership questions. And just a reminder to join us next week with David Berenbaum and Jerry Mayer. But thanks everybody for hanging in there, and have a good of your summer. Thanks, bye.